Good morning, Trinidad and Tobago, and welcome once again to the Bourse Report. For more than 10 years now, we have been providing the entire investment public investor information about what to do, how to invest, and to understand the investment environment. And we continue to do so. Today, I'm going to speak about fixed return investments. That is, short-term bank deposits versus money market rates versus medium-term bonds, both in the Trinidad and Tobago space as well as the US dollar space. So let's begin by looking at what is happening with interest rates in Trinidad and Tobago. And here you would see what is happening is that the yield curve, which is the cost of financing for government, is moving upwards, shifting upwards, as you would see, from the 1-year space out to the 10-year space. What we are seeing is that interest rates have gone up from 2.3 to 2.8% at 1 year. And at the 10-year marker, interest rates have gone up from 3.2% to 4.4%. Higher cost of financing. So what does that mean for you, either as a borrower or as an investor or saver? Let's go to our next graph. And what you can see is what I've been saying all along, is that interest rates, the rate at which you would be borrowing at, or the lending rate of banks, have been going up since 2014, and you can see that on this particular graph, whereas it was just 7.5% 2 years ago, it's up to 9%. This is driven by lending policy of the central bank. And the lending policy of the central bank is that over the past 2 years, what is the policy rate, the repo rate, has gone up from 2.75 to 4.75. What it means is that you are now have to pay more at the bank rates for borrowings. Yet on the other side, for the saver, deposit rates at the central bank, this green line here, is flat at 0.2%. I say again, 0.2%, 0.2%. So there has been an increasing spread between what the banks are paying you for your money and what you are paying the banks to borrow at. And therefore, what is it that you can do in terms of the situation? Well, essentially, there is, let me start by talking about the excess reserves. There is a surplus in the banking system of about $3.2 billion out of the $106 billion in deposits. Yet still, if you take a demand-supply configuration, your lending rates are going up by 150 basis points, while at the same time, when you deposit funds, if you are a saver, you are getting on average 0.2%. What does this mean? Are you getting a real inflation-adjusted rate, or is it that the value of your dollar in the bank is falling away? So let's go now to the next table. What can we expect in terms of the Trinidad and Tobago interest rates going forward? Well, we talked about the reserves suggesting, or the surplus in the bank suggesting that there is more money out there that is being borrowed. If you look at the private sector borrowing, it is actually falling over the past year by 0.2 of 1%. So more surpluses into the system. What does it mean? Government borrowing is going up, as I just said, 4.4% at the 10-year marker. The reserve ratio is, if it goes down, there's going to be still more liquidity in the system, meaning that we are at the highest levels in terms of government, the central bank holding of every dollar raised by the bank. It's 17%. So for every dollar raised by the bank in deposits, the central bank holds at 0%, 17 cents of that dollar. Investor demand, looking for investments, investor demand is going up because of the paucity of investment opportunities. Yet still, our expectation is that interest rates will go up more in reflection of the credit quality or the credit rating as government borrowing increases, one, and also the level of confidence about repayment or shall I say the credit rating, shifts downwards. Let's see what's next. The total rate of return on emerging market bonds. Now, I'm going to the US dollar side to look at what's happening in terms of the US space. We'll come to inflation on the TT and US dollar side in a little while to speak about what is your real rate of return as an investor, whether you invest in the short space, bank deposits, money markets, or out into bonds. Total return of emerging market bonds on a 5-year basis, emerging market US dollar bonds. If you look at what has happened here in the 5-year space, investment grade, that is good quality rather than speculative, 52% up. That would have been your value if you had $100,000 to invest. You would have gotten $152,000 over a 5-year period. High speculative bonds, it would have been 72%. That is bonds that are below investment grade. And if you look at 3-year, 1-year, etc., year-to-date, what you can see to this side of your screen, you would see year-to-date emerging market high yield will be 18%, emerging market investment grade, which is reasonably quality, 11% as you look forward. So what can we expect, or what can you expect as an investor in the bond space, looking particularly at regional bonds that have come forward over the last a couple of years? Very recently, Suriname issued a bond, a 10-year bond. This is a B+ bond, which is speculative grade, yielding at the current trading levels 8.4%. That's a far cry from other investments that you would have had to make. Let's look at Sagicor, which came out last year, I believe, trading at 5.5%. Let's look at Petrotrin 2019, just a short time away, 4.7%. Barbados, B-, 6.5%. And the Trinidad and Tobago sovereign, 4%. Now, in this space will come soon the TGU, Trinidad Generation Unlimited, which is the electricity generation plant. And the word is that it will come at or near the government of Trinidad and Tobago. It's a 10-year bond going on out there, and it's going to come in at somewhere about 4.1 to 4.5%. That's the word in the market. What's in it for you? The real return to TT dollar investors. The real return to TT dollar investors, when you take inflation at the current rate, or over the last year of 3.1%, and you implant that into what is happening with interest rates, what can you see? You can see the real rate of return for the TT dollar saver now. It's in negative territory if you look at the short term, at negative 2.9%, because you are getting 0.2% and inflation is 3.1%. As you go out longer, 4.4% 10-year money or thereabouts. As you go longer along the curve, your real rate of return. This is assuming that interest rate, inflation as it is right now, continues over the period. So the fact is that you are losing money by staying short, and your dollar tomorrow is worth less than it is today because of inflation eating into that value even as you invest. In the TT dollar space, let us look very carefully. What you can see is that with interest rates at 1.5% in US dollars, as you can see that on the short end, you're also losing money, but on the long end, you are up about 2.89% as of year-to-date. Last year, you would have been 4.38%. These are some of the thoughts that I wanted to share with you to talk to you about what's happening. If you want to invest, some thoughts are invest to achieve inflation-adjusted positive real returns. 2, that you go out longer. 3, we talk about diversification into the US and into the TT space. Much more information is available if you go to our website, bourseinvestment.com, And you can call us at 628-9100. Look for us for our various mutual funds under Bourse and Safe Invest. And look at our retirement fund, which is providing reasonably good returns, as you can see at the bottom of your screen. Have yourself a wonderful investment week. This is Subhash Ram Kelawan for the Bourse Report.